Picture this. It's the final week of the 2025 to 2026 fiscal year in India.
Right. Late March.
Yeah, late March. And you're standing on the floor of a major institutional trading desk in Mumbai.
Oh, man.
And the numbers flashing across the Bloomberg terminals, they aren't just red. I mean, they're this deep, alarming crimson.
It was a bloodbath.
You look up at the main board, and the figure is just staggering. The Indian Rupee has dropped past 94.80 against the U.S. dollar.
Yeah.
Which translates to what, a 9.88% plunge over a single fiscal year?
It's actually the worst annual fall in 14 years.
Wow.
Yeah, and a drop of that magnitude, it doesn't just make headlines. It fundamentally alters the psychology of, well, the entire financial ecosystem.
Right, because it evokes these visceral, almost traumatic memories, especially for anyone who's working in finance during the 2013 taper tantrum.
Oh, absolutely. The taper tantrum is still a sore subject.
Because back then, the U.S. Federal Reserve just hinted at pulling back their quantitative easing.
Just a hint.
Just a hint. And emerging markets absolutely collapsed.
Right.
Foreign capital fled. The rupee crashed roughly 15% in a matter of months. And India was suddenly branded part of the Fragile Five.
Yeah, which is a label no central bank ever wants.
Exactly. So when traders see 94.80 flashing on their screens in 2026, that muscle memory just kicks in.
The panic is immediate.
Right. The headlines start screaming about a currency in free fall. And the immediate assumption is that the country is just teetering on the edge of a sovereign crisis.
And, the panic is totally understandable, but it only tells you what is happening on the highly visible, incredibly volatile surface.
Just the tip of the iceberg.
Exactly. It completely obscures the mechanical gears operating underneath. Because the 2013 taper tantrum, that was a story of genuine vulnerability.
Right. Structural weakness.
Structural weakness, yeah. But what is happening in 2026? While it looks identical on a trading terminal, it's functionally the exact opposite.
And that's exactly why we're here. We have this massive stack of expert financial analyses, government reports, institutional research from places like Goldman Sachs, MUFG, Jefferies.
And the Reserve Bank of India itself?
Right, the RBI. So our mission for this deep dive is to really unpack the hidden machinery of that 94.80 number.
Because it's a fascinating story.
It really is.
Yeah.
We are going to prove to you that this historic depreciation is not some simplistic story of domestic economic failure.
Or a central bank asleep at the wheel.
Exactly.
Yeah.
It is actually a complex, absolutely fascinating tale of global geopolitics, weaponized trade wars, and just incredibly high-stakes central banking.
We are essentially looking at the intersection of international relations and macroeconomics just playing out in real time.
Right.
It's honestly a masterclass at how a modern economy insulates itself from global chaos.
So whether you are an analyst trying to model emerging market risks, or maybe you're an entrepreneur trying to keep your manufacturing business afloat,
or just a regular consumer.
Yeah, if you're just noticing that your imported electronics or your summer travel plans are suddenly vastly more expensive,
you're definitely feeling it.
Oh, for sure. We were going to decode the mechanics of global currencies for you. So, okay, let's unpack this.
Let's do it.
Because to understand the rupee today, we actually have to unlearn a deeply ingrained narrative.
Yes.
About what makes money strong or weak.
And that unlearning process, it's really the foundation of everything we're going to discuss today, because there is a massive fundamental disconnect between how the general public views a currency's exchange rate and how macroeconomists view it.
It's like two different languages.
Totally. In academic circles, we refer to this as the political economy of exchange rates.
Right. And the public perception is so pervasive because it's tied to identity, isn't it?
It's extremely emotional.
Yeah. Like when we watch a political debate or read a local newspaper, the exchange rate is framed as a matter of national pride.
Like a scoreboard.
Exactly. It's treated like a global scoreboard. The logic goes, well, a strong nation must have a strong economy, right?
And a strong economy must produce a strong currency.
Exactly. It is a very linear, populist way of keeping score against the rest of the world.
But the problem with that linear thinking is that it treats a complex financial instrument like an Olympic medal tally.
Right.
So hitting 90 and then breaching 93 and finally blowing past 95 to the dollar, it feels like a severe psychological defeat.
It feels like losing.
It feels like the country is losing its standing on the global stage, and obviously the political opposition will absolutely weaponize those numbers.
Oh, of course, to claim the sitting government is mismanaging the sovereign treasury.
Exactly.
But we can't really dismiss that psychological defeat, can we? Because it's backed up by very real, immediate, localized financial pain.
Oh, the pain is very real.
I mean, this isn't just theory for a middle-class family in Delhi or Bangalore. India is fundamentally an import-dependent economy when it comes to absolute necessities.
Right. Energy, mostly.
Yeah, we are talking about crude oil to power the transportation grid, edible oils for basic cooking, consumer electronics.
All the stuff that powers the modern workforce.
Yes, exactly.
And the transmission mechanism of that pain is imported inflation.
Right.
When the rupee drops nearly 10%, the cost to acquire those vital goods on the global market jumps by an equivalent, if not greater, margin.
So a family feels it instantly at the petrol pump?
Immediately.
They feel it when they go to the grocery store.
Yeah.
And think about education. If a family has spent a decade saving up to send their child to a university in the US or the UK,
Oh, man. Yeah.
a 10% currency depreciation literally vaporizes a massive chunk of their life savings overnight.
Because the tuition bill didn't change.
Right. The tuition's the same, but the amount of local currency required to pay it just skyrocketed.
Yeah.
So the public looks at the flashing red numbers, they feel the pinch in their wallets, and they scream that the central bank is failing them.
Right. And economists call this the mercantilist fallacy.
The mercantilist fallacy.
Yeah, it's this deeply flawed, outdated idea that a strong nominal currency universally equals a strong underlying economy.
Which isn't true.
Not at all. If we strip away the emotion and look at the expert consensus across all our institutional sources, the exchange rate is not a sovereign scoreboard at all.
What is it then?
It's a macroeconomic pressure valve. It's actually designed to be a shock absorber.
Okay, a shock absorber. But I'm looking at the government's own economic survey for 2025 to 2026, and I see this glaring contradiction.
The domestic numbers.
Yeah. It seems to challenge that whole shock absorber theory.
Right.
Because the internal engine of the Indian economy was growing at roughly 8% in the first half of the fiscal year.
Which is massive.
It's huge. And retail inflation was remarkably low, contained between like 2.2% and 3.75%.
Right.
Credit growth was robust. Corporate balance sheets were arguably the healthiest they have been in a decade.
Everything looked great on paper.
Right. So if the internal mechanics are humming along that perfectly, why on earth is the currency bleeding out?
It seems like a paradox.
It really does.
Yeah.
Isn't it a paradox that the fastest growing major economy in the world has one of the worst performing currencies?
It absolutely looks like a paradox until you zoom out and look at the borders.
Okay.
India's incredibly strong domestic performance has essentially collided head-on with a fragmented, highly hostile global system.
Right.
We are operating in an era where the global financial architecture does not automatically reward domestic economic success with currency stability.
So the domestic engine is fine.
The domestic engine is like a V8 running on premium fuel, but the road it is driving on is covered in ice and landmines.
I love that analogy. So the damage is entirely external.
Entirely.
Let's run a hypothetical scenario to see how this pressure valve actually functions.
Okay.
Let's say the Reserve Bank of India, the RBI, caved to the populist pressure.
Oh, boy.
Yeah. Let's say they decide they cannot stand the political heat of 94.80, and they decree that the rupee must be artificially defended at a strong level.
Like forcing it to stay at 83.
Right, forcefully keeping it at 83 to the dollar. What are the actual mechanics of defending that vanity number?
Well, defending an indefensible peg is honestly one of the most destructive things a central bank can attempt.
Really?
Yeah, because to force the rupee to stay at 83, when the global open market says it should be 94, the RBI would have to step into the open market every single day.
And do what?
Artificially create demand for the rupee.
Okay.
And they do this by dumping massive amounts of their own sovereign US dollar reserves and buying up rupees.
So they're essentially buying their own stock to keep the price up.
Exactly.
But they only have a finite amount of US dollars in the vault, right?
Precisely. They'd eventually run out. But the secondary effect is actually even more devastating.
Oh, so?
By aggressively buying rupees, they are systematically sucking domestic liquidity out of the local banking system.
Oh.
And to make the rupee attractive to foreign investors so they don't sell, the RBI would also be forced to aggressively hike domestic interest rates.
Oh, wow.
They would have to push rates so high that holding rupees becomes, mathematically irresistible.
Wait, if they hike interest rates massively just to defend the currency, they're making borrowing incredibly expensive for everyone inside the country.
Everyone.
Like the small business owner trying to take out a loan for a new tractor, or the middle-class family trying to secure a mortgage.
Yep.
Even the corporate giant trying to build a new factory.
Yeah.
Their capital cost would just go through the roof.
They would effectively choke that 8% domestic growth to death.
Just to save the currency.
It's to maintain a politically palatable number on an exchange rate board. They would engineer a severe, localized economic contraction.
They destroy job creation.
Bankrupt, over-leveraged businesses, all for a vanity metric. So the expert consensus makes it incredibly clear. Allowing this historic depreciation is a highly strategic, rational adjustment.
The rupee takes the hit.
The rupee is taking the beating so that the broader domestic economy doesn't have to.
The currency is the sacrificial lamb, keeping the 8% growth rate alive.
Yeah. Exactly.
But, okay, if the rupee is the shock absorber, we really need to examine the exact shocks it is currently absorbing.
And they are massive.
Right. To plunge nearly 10% in a year, those impacts have to be systemic.
They are. The anatomy of this historic low is driven by a confluence of 3 massive exogenous shocks.
3 of them.
Yeah. These are external force majeure events that hit sequentially, and then they overlapped.
Creating a perfect storm.
A perfect storm that just overwhelmed the natural defenses of the currency. We're looking at a localized energy crisis, a targeted trade war, and the resulting contagion of capital flight.
Let's start with the energy shock, because that seems to be the primary catalyst here based on the sources.
It absolutely was.
They point directly to late February 2026, the geopolitical conflict in West Asia.
Specifically, the long-simmering tensions involving Iran and Israel.
Right. It aggressively escalated past the point of, proxy skirmishes and into direct, sustained confrontation.
And the immediate reaction in global commodity markets was violent.
I remember seeing the charts.
Yeah, a massive geopolitical risk premium was instantly priced into the curve. Brent crude oil, which serves as the primary global benchmark, had been sitting at a relatively manageable baseline of $70 a barrel.
Which is fine.
Totally fine. But within days of the escalation, it surged to 110. And during the peak stress moments, it threatened to breach $120 a barrel.
Let's look at the arithmetic of that price spike for India, because it's just punishing.
It's brutal.
India imports roughly 85 to 90% of all its crude oil requirement.
Yep.
You can basically think of this dependence as a structural, unavoidable tax on the entire Indian economy.
And crucially, it's a tax that must be paid in U.S. dollars.
Right.
But the vulnerability isn't merely the sticker price of the barrel, it is the physical geography of the supply chain.
The shipping routes.
Exactly. Historically, about 20.9 million barrels of oil per day flow through the Strait of Hormuz.
Which is tiny.
It's tiny. That is roughly 26% of all global petroleum liquids consumption, squeezing through this incredibly vulnerable maritime choke point between Iran and Oman.
Now, I know India has spent the last few years aggressively diversifying where it buys oil.
They have.
Like including purchasing massive discounted volumes from Russia.
Right.
But our sources note this really terrifying statistic. Despite that diversification, approximately 40% of India's total oil imports still transit directly through that specific, highly contested waterway.
So when rockets are flying near the Strait of Hormuz, insurance premiums for oil tankers skyrocket.
Supply lines are delayed.
And the spot price of crude goes vertical. And that math hits the rupee instantly.
How instantly?
Well, for every sustained $10 increase in the price of a barrel of crude oil, India's current account deficit widens by billions of dollars.
Because the domestic oil marketing companies, the OMCs, they don't have the luxury of waiting out the market.
They can't wait.
They can't just tell the transportation sector or the airlines, hey, fuel's too expensive this week, you should probably stop driving or flying.
Right. The demand is completely inelastic. The country has to move.
So the OMCs have to go into the spot market and buy exponentially larger quantities of U.S. dollars to settle those massive inflated import bills.
Picture that trader on the desk we talked about in the intro.
Right.
The OMC calls them up and says, look, I don't care what the exchange rate is today. I need $500 million US by tomorrow to pay for a tanker of crude, or the grid shuts down.
Wow.
So they are indiscriminately dumping rupees into the market to harvest dollars.
It's a non-discretionary panic buy.
Exactly, and that acts like a relentless hammer on the currency.
And that energy shock alone would be enough to cause a severe depreciation.
Just by itself, yes.
But while the rupee was absorbing that continuous blow from the Middle East, the second shock arrived from a completely different theater.
Washington, D.C.
Right. The August 2025 U.S. tariff shock.
This was massive.
The United States rolled out sweeping, aggressive 50% tariffs on an estimated $45 billion swath of Indian exports.
Yep.
And what stands out so glaringly in the research is the sheer targeted asymmetry of this policy.
The asymmetry is the crucial detail here. Because the U.S. did not apply a blanket 50% tariff to all of its Asian trading partners in some, broad protectionist sweep.
What were the other rates?
They applied a 30% tariff to China,
Okay.
20% to Vietnam, 19% to Indonesia, and 15% to Japan.
Wait, really?
Yeah. India was uniquely singled out and walled off of the 50% penalty.
Which completely crippled India's price competitiveness in what is historically its largest single export market.
Utterly crippled it.
Let's make this tangible for the listener. Imagine an automotive parts manufacturer sitting in Chennai.
Okay.
They produce a specific gear assembly for $100. A competitor in Ho Chi Minh City, Vietnam, produces the exact same assembly for $100.
They're tied.
They're tied. But under the new rules, the Vietnamese part lands in Detroit costing $120. The Indian part lands costing $150.
And the buyer in Detroit is going to look at that.
And they're going to buy the Vietnamese part. The manufacturer in Chennai is mathematically priced out of the supply chain overnight.
And you have to layer this sudden export collapse on top of India's pre-existing structural realities.
What do you mean?
Well, India historically runs a merchandise trade deficit. They always import more physical goods like electronics, machinery, and of course oil than they export.
But they usually balance that out with their services sector, don't they?
Usually, yes.
Because India has a massive, incredibly robust services surplus. The sources show over $135 billion in surplus for FY26.
Driven by IT consulting, business processing.
And huge remittances from the Indian diaspora working in the Middle East and the West.
Right. And that $135 billion services surplus is a magnificent buffer. But it wasn't remotely enough to plug a hole of this magnitude. The hole was just too big.
Because the goods deficit was expanding violently from both ends simultaneously. You are hemorrhaging dollars to pay for $120 oil on one side.
And your dollar revenues from exporting goods to the U.S. are collapsing on the other.
Exactly. The economic survey highlighted the brutal result. Between April and November 2025, India's balance of payments slipped into a massive $22 billion deficit.
That's huge.
It is one of the largest and most rapid historical shortfalls on record.
Okay, so put yourself in the shoes of a global institutional investor.
Like a portfolio manager.
Right, a portfolio manager sitting at a massive fund in New York or London. You are evaluating emerging market risks. You look at India's dashboard.
And what do you see?
You see the oil bill skyrocketing due to a war. You see their exports getting crushed by targeted U.S. tariffs. And you see the balance of payments plunging deep into the red.
It's not a pretty picture.
No. It doesn't take a genius to figure out how global capital reacts to that dashboard.
It triggers absolute epic panic, which forms our third shock, capital flight.
Yes. And to understand why the flight was so violent, you have to understand the ruthless mechanics of foreign portfolio investors, or FPIs.
Walk us through how an FPI actually calculates their success. Because it is fundamentally different from how a domestic Indian investor looks at the market.
Okay, so a domestic investor in Mumbai buys a stock. The stock goes up 10% in rupees. They sell it, and they are thrilled.
Right, pure profit.
But an FPI sitting in New York doesn't evaluate their returns in local currency. They are strictly evaluated on dollar-denominated returns.
Because they have to report back to their clients in dollars.
Exactly. Eventually, they have to liquidate their Indian assets, convert those rupees back into U.S. dollars, and hand the profits back to their American pension fund clients.
So the currency risk is just as important to them as the stock market risk.
It's paramount.
So if an FPI puts $10 million into the Indian stock market and they pick a great portfolio that gains 12% in local rupee terms.
But over that exact same holding period, the rupee itself depreciates by 10% against the US dollar.
When they go to sell those stocks and convert the money back, the 10% currency loss almost entirely wipes out the 12% equity gain.
They are left with a paltry 2% net return.
For taking on the significant geopolitical risk of an emerging market.
Right. They would have made more money leaving the cash in a risk-free U.S. Treasury bond.
That is wild.
So a structurally depreciating currency acts as a silent, continuous tax on dollar-denominated returns.
It just eats away the profits.
Yep. As the rupee breached 90 and then slid past 92, Indian assets became mathematically toxic for foreign funds.
The risk-reward ratio just inverted.
Completely. Global capital began a stampede toward the exits, fleeing to the ultimate safe haven of the US dollar.
And the scale of the outflows is staggering in the research. In March 2026 alone, global funds pulled $11 to $12 billion out of Indian equities.
And another $1.6 billion out of the domestic bond market.
Right. And if you look at the aggregate data for the entire 2025 to 2026 fiscal year, total portfolio outflows hit $16.4 billion.
Which is historic.
Our institutional sources explicitly note that a volume of capital flight hasn't been seen in 28 years.
And it creates a self-fulfilling prophecy, a vicious downward spiral.
How does that loop work?
Well, when foreign funds sell $12 billion worth of Indian stocks, they don't want to hold the rupees they get from the sale.
Obviously not.
They immediately dump those rupees into the currency market to buy dollars to repatriate their funds.
Right.
That massive concentrated dumping of the local currency forces the rupee even further down.
Which then triggers the stop-loss limits of other foreign investors.
Exactly, who then sell their stocks, creating even more rupee dumping. It just feeds on itself.
Okay, so with tens of billions of dollars flooding out of the country, the currency plummeting nearly 10%, and the public panicking about imported inflation.
It looks bad.
The natural assumption is that the central bankers in Mumbai are having a complete meltdown.
Right. You'd picture a war room in absolute chaos.
Screaming, running around. But the research reveals something entirely counterintuitive.
The RBI isn't panicking.
They are surprisingly calm. Because they are looking at a completely different dashboard to measure the rupee's true health.
Yes. While the media, the politicians, and the public obsessively watch the bilateral USD to INR rate.
That terrifying 94.80 number on the screen.
Right. The central bankers are focused almost entirely on the R.
The real effective exchange rate.
The RRE.
This is the secret metric. This is the Rosetta Stone that translates the central bank's actual strategy. Let's thoroughly demystify the routier.
It's crucial.
How does this mathematical model actually work, and why is it superior to just looking at the dollar exchange rate?
It is an incredibly elegant mechanism. The rupee acknowledges that India does not solely trade with the United States.
Right, they trade with the whole world.
Exactly. So it measures the rupee against a weighted basket of 40 different currencies.
40.
Yep, representing India's major global trading partners. So you have the euro, the yen, the dirham, the yuan, and so on.
And it's weighted.
Weighted based on the volume of trade with each country.
Okay, so it's a broader average.
Yeah.
But what makes it real instead of just nominal?
The real aspect is the genius of the metric. It mathematically adjusts all of those exchange rates to account for the inflation differentials between India and those 40 specific countries.
Okay, let's ground this with an analogy. I like to think of the REER like a golf handicap.
Oh, I like this. Go on.
So the nominal exchange rate hitting 94.80 to the dollar is like your raw score on a round of golf.
Yeah.
If you shoot a 95, it looks like a terrible score on paper.
Right.
But the REER is the handicap system. It adjusts your score based on the extreme difficulty of the course you played in this case, the global inflation environment,
Exactly.
and the skill level of the 40 different players you competed against.
That is a perfect way to visualize it. It adjusts for real, on-the-ground purchasing power, not just the nominal sticker price flashing on a terminal.
Right.
And the scoring system the RBI uses for the REER is beautifully simple.
An index of 100 is the baseline equilibrium.
Correct. A REER score over 100 indicates that the currency is overvalued compared to its historical fundamentals.
And overvalued is bad.
An overvalued currency is a massive headwind for a developing nation. It makes your exports relatively more expensive and far less competitive on the global stage.
Like the Chennai auto parts.
Exactly. Conversely, a score under 100 means the currency is undervalued.
Which is good for exports.
Theoretically, yes.
Yeah.
An undervalued currency gives your domestic exporters a massive pricing advantage against foreign rivals.
And this is where the data trajectory in our sources becomes incredibly revealing.
The numbers tell the whole story.
In January 2025, before the energy shocks and the tariffs hit, the RBI's 40 currency REER index was sitting at 104.7.
The rupee was significantly overvalued.
It was too strong for its own good. But by November 2025, it had dropped to 97.5.
A huge move.
And if you look at the early 2026 data provided by the Bank for International Settlements, the BIS, their broad index, showed the Indian REER plunging all the way down to 91.78.
And hitting 90.51 by February.
That is a massive structural correction. The rupee swung from being 4.7% overvalued to nearly 10% undervalued in the span of a year.
And the government's own economic survey didn't try to obscure this fact.
No, they didn't.
They explicitly admitted in their own formal documentation that the rupee is currently, quote, punching below its weight.
Punching below its weight.
They are openly acknowledging that the currency is severely undervalued compared to the actual 8% growth strength of the domestic economy.
And they are acknowledging it because that undervaluation is not a failure. It's a brilliant, deliberate macroeconomic strategy.
Exactly.
By allowing the REER to drop into the low 90s, the RBI is deliberately deploying the shock absorber we discussed earlier. Yes.
Explain exactly how that undervaluation works as a defense mechanism for a business on the ground. Like, how does a falling REER act as a shock absorber against those crushing 50% U.S. tariffs?
Let's go back to our manufacturer in Chennai. But this time, let's look at an apparel exporter.
Okay, making clothes.
Right. The U.S. slaps a 50% tariff on their shipments of cotton shirts.
Okay.
To have any hope of continuing to sell in the U.S. market, the Indian exporter has to slash their dollar-denominated asking price to offset the tariff for the American buyer.
They have to eat the cost.
They have to eat it, which completely crushes their profit margins. They're looking at bankruptcy.
But the currency moves to save them.
Exactly. If the rupee has simultaneously depreciated by 10% against the dollar, the calculus changes entirely.
How so?
Yes, the exporter is earning fewer U.S. dollars per shirt because they cut their price. But every single one of those dollars they do manage to earn
Translates back into way more rupees.
significantly more rupees when they repatriate the funds to India. So the cheaper currency acts as a stealth subsidy.
It's a massive stealth subsidy.
It artificially pads their rupee revenues on the back end, giving them the financial oxygen to survive the margin compression caused by the U.S. tariffs.
Precisely. If the RBI had been stubborn and kept the rupee artificially strong at 83, that textile exporter would have faced the full brunt of the 50% tariff without any currency buffer.
And the factory would have padlocked its doors.
The central bank essentially engineered a devaluation to subsidize the export sector without having to pass an actual subsidy bill through Parliament.
That's incredibly smart.
It was so overt and deliberate that the International Monetary Fund, the IMF, officially intervened and changed India's exchange rate regime classification.
Yeah, the sources say they moved India from a stabilized arrangement to a crawl-like arrangement.
Crawl-like.
Crawl-like is a very specific, highly descriptive piece of bureaucratic terminology.
It really is. It is the IMF formally acknowledging that the RBI is no longer strictly defending a specific number.
They're letting it slide.
They are allowing the open market to gradually, deliberately devalue the currency within a controlled downward trend band.
To absorb the geopolitical blows.
Exactly.
So if you stop the analysis right here, it sounds like an absolute masterstroke.
A textbook success.
Right. The rupee weakens, the exporters get a stealth subsidy, domestic growth stays at 8%, and Indian manufacturing is shielded from the hostility of U.S. protectionism. It sounds perfect.
It does.
But our deep dive into the sectoral analysis, looking at the actual quarterly earnings reports of different industries, shows that the reality on the ground is vastly more complicated.
And honestly, quite brutal.
Very brutal. Textbook economics assumes that a weak currency uniformly and equitably boosts all domestic manufacturing.
But the sources clearly debunk that myth.
What we are witnessing in India right now is a severe bimodal distribution of economic impact.
Bimodal distribution.
Right. The depreciation has created extreme, unassailable winners and catastrophic existential losers. There is no middle ground.
You are either getting rich or you are getting wiped out.
Exactly. Let's examine the winners first. The undisputed champions of this depreciating environment are sectors that feature incredibly high domestic value addition and have virtually zero reliance on imported raw materials.
Specifically, information technology services.
The IT sector.
The behemoth IT consulting firms and business process outsourcing centers based in Bangalore, Pune, and Hyderabad, they are the ultimate apex beneficiaries of a collapsing rupee.
Walk us through the P&L, the profit and loss statement of a Tier 1 IT firm to show why they are winning so massively.
Well, it's an incredible arbitrage of geography.
Okay.
A Tier 1 IT firm bills almost all of its massive global clients, banks in New York, retailers in London, logistics firms in Europe in US dollars or euros.
So their revenue is entirely hard currency.
Entirely. But their major operational expenses, paying the salaries of tens of thousands of software engineers, leasing massive tech parks, paying for local servers and electricity, are entirely paid in local rupees.
So when the rupee drops 10%, their costs effectively shrink by 10% relative to their revenue.
Without them doing a single thing differently.
Wow.
The operational leverage is staggering. Our sources note that for every single 1% drop in the rupee against the dollar, these Tier 1 Indian IT firms see an automatic 20 to 30 basis point expansion in their operating margins.
So a 10% rupee drop is essentially a massive unearned windfall cascading directly to their bottom line.
It's pure profit.
It acts as a giant financial buffer, artificially inflating their profits at a time when global discretionary tech spending is actually slowing down due to high interest rates abroad.
It's perfect timing for them.
Pharmaceuticals and specialty chemicals also largely fall into this winner's category, right? Because they export vast quantities of generic drugs and earn in dollars.
Mostly, yes. But there's a crucial, dangerous caveat hidden in their supply chains.
Right. Their benefit is highly conditional.
It depends entirely on what they import. If an Indian generic pharma company relies heavily on importing active pharmaceutical ingredients, the core chemical components known as APIs from places like China,
the weak rupee suddenly makes those raw materials vastly more expensive.
Exactly. The benefit of their dollar revenue is eaten alive by the cost of their dollar imports.
Which perfectly illustrates the structural flaw in this weak currency strategy. It leads us directly to the extreme losers in this bimodal economy.
The imported input paradox.
The imported input paradox.
Yeah.
It is a devastating paradox that is currently hollowing out traditional manufacturing sectors that the government desperately wants to protect.
Right.
Think of it like a massive infrastructure project. Imagine an Indian conglomerate trying to build a state-of-the-art semiconductor fabrication plant in Gujarat.
Which is a huge priority for them.
The government is pushing hard for domestic chip manufacturing. Now, the local costs, buying the land, pouring the concrete, buying the steel rebar, paying the construction workers, are all paid in rupees. That part is fine.
But the critical technology.
The extreme ultraviolet lithography machines. Those can only be bought from a company like ASML in the Netherlands.
And they cost hundreds of millions of euros.
Exactly. The moment the rupee depreciates 10%, the cost of acquiring that critical machinery surges by tens of millions of dollars overnight.
The capital expenditure becomes prohibitively expensive.
It destroys the return on investment models for the factory. The conglomerate delays the project or cancels it entirely. A weak currency actively penalizes the importation of advanced technology, which acts as a massive headwind to India's broader, long-term industrialization agenda.
And we see this exact same margin destruction acutely in the gems and jewelry sector and the traditional textile sector.
Theoretically, if you read a macroeconomics textbook, these are the exact sectors that should be booming.
They should be printing money.
Right. Indian diamonds polished in Surat and apparel woven in Tirupur should be highly competitive globally with a weak currency.
But the textbook ignores the supply chain.
Right.
A diamond polisher in Surat cannot mine diamonds in Gujarat. They must import rough diamonds from Africa or Russia, and they must pay for them in US dollars.
Same for textiles.
Exactly. An advanced textile mill must import specialized synthetic yarns and high-end weaving machinery in dollars.
So as the rupee falls to 94.80, the cost of their dollar-denominated raw materials surges so high that any advantage they gained on the export price is entirely erased.
Wiped out completely.
Industry reports from the ground show that the net benefit of the depreciation for these traditional sectors is zero, and in many cases, heavily negative.
They are fulfilling export orders at a loss just to keep the lights on.
That's heartbreaking. And then we have the sectors facing what the institutional reports unequivocally call an existential crisis.
Aviation and oil marketing companies.
Their exposure is entirely unhedged and enormous. For a domestic airline flying routes between Mumbai and Delhi, their two biggest operational expenses are aviation turbine fuel and the leases on their Boeing or Airbus jets.
And both of those costs are strictly dollar-linked.
Right. A 10% weaker rupee means their daily operational burn rate explodes. They have no choice but to hike domestic ticket prices to survive,
Which instantly destroys consumer demand.
leading to empty seats and bleeding balance sheets.
So the central bank sitting in Mumbai is watching this bimodal destruction unfold.
They see it happening?
They see the IT sector reaping massive windfalls, but they see aviation nearing bankruptcy, traditional manufacturing getting crushed by input costs, and critical infrastructure projects stalling due to capital formation headwinds.
And parallel to this domestic pain, foreign capital is fleeing at the fastest pace in nearly 3 decades.
Precisely. The RBI realized that while a crawl-like depreciation was a smart textbook strategy for a slow-moving trade issue,
The pace of things was just too fast.
the sheer velocity of the capital flight and the geopolitical shocks meant they couldn't just sit back and let the market dictate the pace indefinitely.
They had to intervene.
They had to restore order.
And that intervention resulted in one of the most dramatic high-stakes showdowns in recent central banking history.
It really was.
Let's examine the RBI's desperate pivot. It happened in 2 very distinct phases. Phase 1 was what the analysts call the orthodox playbook, direct market intervention.
And the orthodox playbook means the central bank physically steps into the currency market to act as the buyer of last resort.
Okay.
They take actual sovereign U.S. dollars out of the national foreign exchange reserves and sell them on the open market.
To absorb the panic and artificially prop up the rupee.
Exactly. But the scale of the external shock was vastly larger than anyone anticipated.
How large?
Well, in a span of roughly 3 weeks, the RBI burned through over $30 billion in cash.
$30 billion in 3 weeks.
Yes. India's fortress of foreign reserves, which had been sitting at a formidable record-high $717 billion, was drained so rapidly it dropped below the psychological $700 billion mark.
Hitting roughly $698.34 billion.
Right. And the damage wasn't contained to just their spot cash reserve.
There's more.
Their forward short dollar book, which is essentially the central bank's legally binding promises to supply U.S. dollars to the market at a future date.
Okay.
That book swelled dramatically from $67 billion in January to over $88.7 billion.
Wow. Look at those numbers. They blew $30 billion in cash and took on another $21 billion in future liabilities in less than a month.
It's staggering.
Were they fundamentally just setting sovereign wealth on fire just to slow down the inevitable?
They were, and the central bank's internal risk committees quickly realized that it was an unsustainable, highly dangerous misallocation of national resources.
Because of what we discussed earlier.
Exactly. If you continuously sell billions of dollars, you are systematically sucking an equivalent amount of rupee liquidity out of the domestic banking system.
Right, because when a bank buys those dollars from the RBI, they have to hand over rupees.
Yep.
That cash disappears from the domestic lending pool.
And draining that liquidity was threatening to spike domestic interest rates organically, completely outside of the RBI's policy decisions.
Which would kill the growth.
If borrowing costs spike, that 8% economic growth they were sacrificing the currency to protect would be killed anyway.
So they were trapped in a paradox of their own making.
They were. They realized they could not outspend the global market. You cannot fight a multi-trillion-dollar geopolitical panic with a finite reserve vault.
It's mathematically impossible.
So they had to change the fundamental rules of the game. Enter phase 2, the regulatory hammer.
This is where the narrative shifts from macroeconomics to highly aggressive regulatory warfare.
It really is warfare.
It is late on Friday, March 27, 2026. The onshore markets are winding down for the weekend. The RBI pivots away from burning their reserves and drops an unprecedented regulatory mandate on the banking sector.
Out of nowhere.
Out of nowhere, they imposed a strict draconian cap on all authorized dealer banks, a maximum net open position, or NOP, of just $100 million in the onshore foreign exchange market.
And we really need to contextualize that $100 million figure to understand how violent of a restriction this is.
Right. What were these banks allowed to hold before that Friday evening circular?
Previously, the regulations allowed massive public and private sector banks to hold open foreign exchange positions equal to 25% of their Tier 1 capital.
which is massive.
For the behemoth institutions, that 25% allowance gave them immense speculative flexibility. We're talking massive currency exposures ranging anywhere from $2 billion to $5 billion per bank.
The RBI took a multi-billion-dollar trading allowance and slashed it down to a flat $100 million effectively overnight.
Over the weekend.
Over the weekend. Why? Why would a central bank drop a regulatory weapon of mass destruction on the profitability of its own domestic banking sector?
To answer that, we have to look into the shadows of the currency markets.
The shadows?
We have to decode the mechanics of the NDF arbitrage loop. NDF stands for non-deliverable forward.
This is a complex derivative. Walk us through how a trader at a Mumbai desk was actually exploiting this loop to print money while the rest of the country panicked.
Okay, it requires understanding that there isn't just one market for the rupee.
There isn't.
No, there are two parallel universes. You have the highly regulated onshore market located physically in India, overseen strictly by the RBI.
Okay.
And then you have the offshore NDF markets located in global financial hubs like Singapore, London, and Dubai.
Oh, I see.
And these offshore markets are utilized by global hedge funds and multinational corporations. But crucially, they're largely beyond the direct regulatory reach of the RBI.
And the non-deliverable part means they aren't actually trading physical briefcases of rupees, right?
Exactly. A non-deliverable contract means no physical currency ever changes hands. It is purely a cash-settled financial bet on the future direction of the exchange rate, settled in U.S. dollars.
So it's just pure speculation.
Pure speculation. Under normal, calm geopolitical conditions, the price difference known as the spread between the tightly controlled onshore rupee and the speculative offshore rupee is negligible.
Like how small?
It might be 5 to 15 basis points, barely a blip.
But conditions in March 2026 were not normal.
Far from it. As the geopolitical panic intensified and foreign capital fled, the offshore market in Singapore panicked much faster.
And aggressively priced the rupee much lower than the onshore market in Mumbai.
Exactly. That tiny 15 basis point spread violently blew out to an enormous 75 to 90 basis points.
And the domestic Indian banks saw an arbitrage opportunity of a lifetime. Explain the mechanics of the trade.
Okay, the trader in Mumbai sees that they can buy the US dollar relatively cheaply onshore in India using the bank's massive domestic rupee liquidity.
Right.
In the exact same millisecond, they execute a contract to sell that US dollar exposure at a significantly higher panic-driven price in the offshore NDF market in Singapore.
So they are buying an apple for $1 in market A and simultaneously signing a contract to sell that exact same apple for $1.10 in market B.
Pure, mathematically risk-free profit.
It is a license to print free money.
It is. But there is a massive systemic consequence. By executing this trade at a multi-billion-dollar scale, the domestic banks were accumulating massive directional bets.
Because to capture the spread.
They were systematically buying dollars and dumping rupees onshore.
Oh.
They were essentially betting against the stability of their own sovereign currency, exacerbating the downward pressure on the rupee just to pad their proprietary trading desk's quarterly profits.
They were feeding the fire to roast their own marshmallows.
That's exactly what they were doing.
The RBI saw this massive parasitic arbitrage loop actively undermining the currency defense. And the $100 million NOP cap was the precision-guided munition they used to obliterate it.
Yeah.
Because the moment that circular drops on Friday night, every head trader in Mumbai realizes they are holding billions of dollars in arbitrage positions that are suddenly unequivocally illegal under the new capital rules.
Which sets the stage for the violent unwind on Monday, March 30th.
What happened on Monday?
When the markets opened, the banking sector was forced into a desperate scramble. To comply with the new $100 million cap, they had to immediately liquidate and unwind an estimated $30 billion to $50 billion in accumulated onshore short rupee positions.
It was absolute unmitigated chaos on the trading floors. It triggered a massive artificial short squeeze.
Because dozens of massive banks were forced to buy rupees simultaneously.
Right, to unwind their illegal trades in a market with very few willing sellers. And the price of the rupee just rocketed up 1.4% in a single trading session,
dragging it back to 93.59.
So the RBI achieved its tactical objective brilliantly. They shattered the arbitrage loop, punished the speculators, and temporarily stabilized the currency without spending a single additional dollar from their sovereign reserves.
But the cost of that regulatory shock therapy was brutal.
Well, yeah. You cannot force a highly leveraged banking sector to violently unwind $50 billion in a panicked one-sided market without someone taking a massive financial hit.
The spread collapsed.
The trades went underwater, and the banks were left holding the bag.
The domestic banks are facing catastrophic mark-to-market, or MTM, treasury losses.
A detailed report from the global brokerage Jefferies estimated the carnage. For every 1 rupee of currency movement during this forced unwinding period, the domestic banking sector could suffer an aggregate one-time hit of 3,000 to 4,000 crore,
which translates to roughly $360 to $480 million in pure treasury losses wiped off their balance sheets.
The central bank made a calculated, ruthless choice. They actively chose sovereign currency stability over the quarterly profitability of the domestic banking sector.
They looked at the banks and essentially said, you will absorb this massive loss so the nation's macroeconomic integrity doesn't have to.
But when a central bank drops a regulatory hammer that shatters the balance sheets of its largest financial institutions, it sends immediate, violent shockwaves through every other market in the country. Let's trace the contagion.
The equity markets were the first domino to fall under the weight of the intervention.
It was a bloodbath. The benchmark BSE Sensex collapsed by 11.4% in a single month.
Massive.
We are talking about a 9,300-point freefall that erased $620 billion in total market capitalization.
And naturally, banking and financial stocks led the crash.
Because institutional investors knew the banks were taking massive, opaque hits from the RBI's forex caps, and the foreign portfolio investors were already fleeing because of the compressed dollar returns we discussed earlier.
And the contagion spread instantly to the fixed income or bond markets.
And your government bond yields spiked aggressively to 6.94%.
Global bondholders were dumping Indian sovereign debt because the currency risk made the yield entirely unattractive.
And looming over all of this financial market chaos is the insidious specter of imported inflation trickling down to the real economy due to the expensive oil. Goldman Sachs issued a stark warning to their clients that Indian retail inflation could breach the RBI's upper tolerance threshold of 6% by the summer.
So it's a very difficult position.
So we have a listener right now who owns a small business, or maybe they are waiting to refinance their home loan. They've been reading financial news for a year, predicting that 2026 would finally be the year interest rates drop.
Yeah.
What does this currency crisis mean for them?
The brutal reality is that the easing cycle is dead for the foreseeable future.
It's just dead.
Dead. That is the universal consensus across all the macroeconomic research. The RBI has absolutely no choice but to hold the baseline repo rate anchored at a restrictive 6.50% for an extended duration.
Why are their hands tied? If inflation was contained earlier, why can't they cut rates to help the businesses hurt by the falling rupee?
It all comes back to defending the currency against capital flight.
Okay.
If the RBI cuts domestic interest rates, the yield on Indian financial assets drops.
Right.
If the yield drops, the interest rate difference, the gap in profitability between investing in India and investing in the United States narrows significantly.
And if that gap closes?
Even more foreign capital will abandon India for the safety and comparable yield of U.S. Treasuries. The RBI must maintain that high 6.50% rate as a mandatory yield incentive to keep foreign capital parked in the country and defend the rupee from further collapse.
They are completely tracked by external forces. Which brings us to the ultimate question of this deep dive. How does this actually end?
That's the billion-dollar question.
Right. As we project the outlook for the remainder of 2026 and into 2027, does the rupee resume its free fall and test 97, or does it miraculously bounce back to 83?
The expert models from the institutions outline two very distinct, highly divergent paths. The near-term path over the next 3 to 6 months is one of extreme, brittle vulnerability.
Because the underlying geopolitical and trade shocks haven't vanished. The root causes are still active.
Exactly. The central bank treated the symptom by stopping the arbitrage loop, but they cannot cure the disease. If the kinetic conflict in West Asia persists and the physical flow of oil through the Strait of Hormuz remains heavily disrupted, crude oil will likely stay anchored above that punishing $100 a barrel mark.
The raw, inescapable arithmetic of India's import bill will continue to crush the rupee.
Several quantitative models suggest it could easily test the 96 to 97 range.
Wow.
Furthermore, the market structure itself is now dangerous.
Because of the cap.
Because the RBI's $100 million NOP cap essentially banned the major banks from providing deep speculative liquidity to the market. The onshore currency market is now incredibly thin.
It's highly prone to sudden, violent flash crashes if a major importer suddenly needs to buy $1 billion.
It is a fragile, tightly wound system.
But what is the catalyst for recovery? What actually turns this macro environment around?
The catalyst relies entirely on global trade diplomacy. The 50% U.S. tariffs are mathematically unsustainable for the global supply chain in the long run. American companies need Indian inputs just as much as India needs American consumers.
So the catalyst for a massive rupee reversal hinges on the U.S. and India negotiating a normalized bilateral trade pact,
bringing those punitive tariffs down to the broader Asian average of roughly 15 to 20%.
If that diplomatic breakthrough happens, the pressure valve instantly releases. The massive trade deficit eases as Indian goods flow back into the U.S. The textile and manufacturing exporters can breathe and expand again.
And the financial model suggests that this sudden trade clarity, combined with the eventual long-delayed normalization of U.S. interest rates by the Federal Reserve, would trigger a massive violent reversal of the capital flight.
Reversing the outflow.
Quantitative analysts project that the $16 billion that fled could turn into $20 billion to $40 billion in FPI capital, rushing back into Indian equities and bonds over a 12 to 18-month period.
So in that bullish, risk-on scenario, the massive influx of U.S. dollars would cause the rupee to surge. The models suggest it could rally all the way back to the 87.50 to 88.50 range.
It mathematically could, but, and this is perhaps the most crucial point of central bank psychology we have discussed today, the RBI will actively prevent it from appreciating that fast or that far.
Wait, why not? If the crisis is over, don't they want the prestige of a strong rupee again? Don't they want the political win of returning to the low 80s?
Absolutely not. Central bankers do not care about political vanity metrics.
Really?
If tens of billions of dollars suddenly flood back into the Mumbai markets, the RBI will step right back onto the trading floor. But this time, their strategy reverses.
What do?
They will aggressively buy all those incoming U.S. dollars, soaking them up from the market to rebuild the $30 billion in sovereign reserves they burned during the panic.
Oh, I see.
By constantly buying dollars and selling rupees, they will intentionally cap the rupee's rise, ensuring it remains permanently mildly undervalued.
Because they learned their lesson. They realized that in a hostile global environment, that stealth export subsidy we talked about, the cushion for the IT firms and the manufacturers, is more valuable than a strong nominal exchange rate.
They want to continue punching below their weight.
It is the ultimate pragmatic strategy. They want to maintain structural manufacturing competitiveness at all costs, even if it means the currency never fully recovers its pre-crisis glory.
It is the currency functioning exactly as it is designed to in a modern, open, and highly vulnerable macroeconomic system. It is the ultimate absorber of global stress.
What a journey. We started this deep dive looking at a terrifying number on a screen, 94.80, and a simplistic populist narrative of sovereign economic failure. But peeling back the layers of these sources reveals a reality that is infinitely more complex.
So much more complex.
The historic depreciation of the rupee is not an accident. It's an intricate, highly strategic, and sometimes brutal dance. It involves the kinetic reality of Middle Eastern geopolitics, the aggressive weaponization of U.S. trade protectionism,
and a central bank that consciously, mathematically chose to let its currency take a severe beating in order to protect its domestic growth engine.
The next time you see a news chyron screaming about a crashing currency, you now possess the analytical toolkit to look under the hood. You know not to look at the bilateral dollar rate, but to search for the REER.
Look for the REER.
You understand the shadowy mechanics of NDF arbitrage loops, and you can visualize how a falling currency acts in a bimodal distribution,
creating massive unearned windfalls for tech conglomerates while simultaneously pushing aviation and traditional manufacturing toward the brink of insolvency. This systemic reality raises a profound, forward-looking question, one that extends far beyond just the borders of India.
Let's hear it.
We are entering an increasingly fractured multipolar world, a world where global trade policies are routinely weaponized, where tariffs are the new diplomacy, and where geopolitical supply chain shocks are no longer black swan events, but the new predictable normal. In that hostile environment, will the deliberately undervalued currency become the ultimate mandatory shield for all emerging markets? Will we soon see an era of global finance where absolutely no developing nation actually wants a strong currency ever again?
A global race to the strategic bottom to protect domestic industry.
That is a fascinating, slightly terrifying thought to leave on. Thank you for joining us on this deep dive. Keep questioning the surface-level narratives of global finance, keep looking for the hidden mechanics, and we will see you next time.